So just now we have seen that debts will be issued in two forms, either issued for indefinite period or issued for definite period. Perpetual was the indefinite period. Now we take the case of when the debts will be issued for redeemable period. That means there will be a specific duration for which the debt will be issued in the market, and after that specific period the redemption of debt has to be there. That means redemption we can say when the debt has been matured. When the debt has been matured, it has to be paid back by the company. Now, some important aspect in this. First of all, in this case, the best method, there are two methods we can say. The shortcut method as well as the next method is trial and error method. And trial and error method is always considered as the best method because we have to hit a specific percentage which can be considered as cost of debt, and from that hit percentage we try to know that whether debt has to be increased or decreased, and then we take the help of interpolation. Start at 6. We take the help of interpolation that how to calculate the exact percentage of cost of debt. But a shortcut method is also provided. But as economists we always say that trial and error is always error free. The exact percentage that we get, because sometimes if the conditions are not fulfilling, then your shortcut method may fail also. But here for discussion we will take up both the aspects. Now how to calculate it? What we have to do? We have to calculate the issue price. First of all, we have to calculate the issue price, and that issue price, we can say we have to bring that issue price equal to the cash inflows for the specific period. That means, suppose the debt is issued for 5 years. That means for 5 years the interest will be received. Every year the interest amount will be there. We have to discount that interest amount. After discounting the interest amount, the present value of interest amount will be calculated. We sum up the present value of the interest amount, and then we try to equate that thing with the issue price. What I am trying to say, we keep issue price on the left hand side, and then we try to equate the issue price with the present value of future cash flows. But at what rate that future cash flows have to be discounted, that rate we are trying to decide, and that is itself called as cost of capital or cost of debts. The discounting rate, if you remember, while discussing about the cost of debts, I said that it also helps us in investment decision. It helps us in discounting the cash flows itself for arriving the present value. Now the first aspect is that we are supposed to know, or we are supposed to calculate the issue price. Now see, issue price, basically we can say it must be having face value, or we can say it must be having some face value. From face value we add the premium minus the discount and minus the floating charges or floating expenses. Floating expenses means payment made to underwriters, payment made against brokerage as a fee, or other issue charges. So whenever we make the issue of any debts, there are certain number of charges. Those charges are called as floating charges. One thing you have to keep in mind: floating charges or floating expenses will always be calculated on face value or issue price, whichever is higher. What I am trying to say, if the face value is 100 and discount is there of 5%, issue price becomes the 95. So issue is 95 and face value is 100. Higher is face value. On face value it will be calculated. But if the issue is at premium 5%, it will become as 105. Face value is 100. Higher is issue price. So floating charges will always be calculated on face value or issue price, whichever is higher. Second most important thing, like I have taken up an example also, interest. Interest is always calculated on face value, not on the issue price. Issue price may be at premium or at discount. We are not considered. Interest is always given on the face value. These two things that you are supposed to keep in mind. So in this way we are able to calculate the issue price. Now we have to equate. We have to equate the right hand side is equal to left hand side. For that we make the equation. Issue price is equal to summation T in the first year. From the first, because we will receive the cash flow or we will make the payment of cash flow from the first year itself till the nth year. Till the nth year. You have interest. You will make the payment of interest on the yearly basis, tth year we can say, divided by 1 plus kd, 1 plus kd power t. Kd is the cost of capital. Now, if the issue remain in the market for 5 years, this equation will go for first year, second year, third year, fourth year and fifth year, because we have said from first year to nth year. Nth year is the fifth year. And in the fifth year, redeemable case is there. Redemption has to be done. Redemption, it can be done at premium, it can be at discount, or it can be at face value we can say. So we can say after this, there will be redemption. BN, bond has to be redeemed in a nth year. Again, 1 plus kd power n in the nth year. 1 upon kd, I told you earlier also, it is the discounting factor. Here kd is the discounting rate. Here kd is the discounting rate for discounting the cash flow. Cash flow is the interest amount. Interest amount will be discounted at some percentage. The rate at which interest amount will be discounted, that rate will be called as the cost of capital. Here this is unknown, this is known, this is known, period is known, KD is unknown. So discounting is the rate which brings right hand side equal to left hand side. So we have to hit, I said we are trying to take up the method as trial and error method. That we have to hit a percentage. We have to assume the value of KD. Suppose as 10%. We will keep 10% here and then we try to calculate the sum of right hand side. If is equal to left hand side, that will become the value of KD. Or else we can increase or decrease if the value is not matching with the left hand side. Right? We take an example. The example has been given. A company makes the issue of a debenture of 12.5% as interest, and the issue, the face value is given as rupees 100. This debenture is issued for 7 years at discount of 5%. Floating charges are given as 1. Tax rate is given as 40%, and we are supposed to calculate the cost of debts. So in this case, first of all, we have to calculate the issue price. That what will be the issue price? Issue price is given as 100 minus discount. Discount is rupees 5. It is 5%. Floating charges are given as 1, and I already said floating charges will be calculated on the face value or issue value, whichever is higher. So face value is higher, because issue value becomes as 95 minus 1. it becomes as 94. So 94 is your issue price. Right? Interest. Already I said interest will be on the issue price. No matter what, interest will be on the face value. No matter what is the issue price. So interest will be 12.5. Rupees 12.5 per year. We try to put in this case, suppose we say as B0. B0 is 94 is equal to interest. One more thing, I will like to make it clear itself. You can deduct tax from the interest here itself. When you deduct the tax here itself, automatically the KD will be after tax. Or else, simply you calculate without tax and after that you can apply an equation 1 minus T. Both the things are open to you. So we can say as 12.5. 12.5 interest 1 plus KD in the first year. Again 12.5 1 plus KD in the second year. This will go till 5th year. 12.5 upon 1 plus KD in the 5th year. And in the 5th year we have the maturity also. Nothing is provided, we will assume the maturity is at face value. Maturity can be at face value, at premium or discount if the problem says. Here the problem is silent about the maturity value, so we will assume it will be at face value. So plus 100 upon 1 plus KD power n. N is the life, that is 5, that is 7 years. Sorry, here it was 7 years, yes. Here it was 7 years. It will go till 7 years. Here it will go till 7 years. The 7th year itself. And this will be also your 7th year because we have not writing the equation. The problem is known to us. This is 7. What you have to do? With the help of trial and error method, you have to assume some initial percentage. You have to assume some initial percentage, the value of KD. You put, suppose you take as 10%. Now 10%, you calculate the value for right hand side and try to see that what is the sum. The sum may be 94, more than 94 or less than 94. If it is more than 94, it has to be reduced. For reducing, the value of KD has to be increased, inverse relation. That means we will again take up 12% or 13% or 14%. So one value we have taken at 10%, another may be at 15% suppose. Or suppose it comes to less than 94. Then we have to increase this. For increasing this, we will decrease this. In this way, you will find out only two, 12% or 15%. That means the value of KD lie between 10 or 15. That means 10 plus something. We apply statistics, interpolation method. With the help of interpolation method, we will derive the exact value of KD. Right? We will take up just now. You have to put or you have to assume the value of KD as 10%. Suppose we assume KD is equal to 10%. One more thing you can do. Either you can put 10% here and with the help of calculator you can do, or you are also aware you can make use of present value table. Present value table. Like you can say, you can draw two columns, year and interest. Year and interest. Year is first year, second year, third year, fourth, fifth, sixth, seventh. 7 year? Yes. And one more 7. Maturity. And here we can say we have 12.5, 12.5, 12.5, 12.5, 12.5, 12.1, 2, 3, 4, 5, 6, 12.5, and lastly it is 100. Maturity is 100. What you can do? You can multiply this with the present value table. That is, we have taken KD is equal to 10%. You have to see the value of rupee 1 in present value table, like 0.909, 0.826, 0.751, 0.681, 0.682, 0.621, and in the 6th year and 7th year, and again 7th year. Multiply this thing, you will get the present value. Here you will get the present value. You sum up, right? You do it yourself. अब बताइए प्रेजेंट में मतलब हम ये कह रहे हैं, so we are aware that the cost of debts or the issue price is 94. From the equation just now we have drawn, we have to forecast or we have to hit a percentage for the cost of debts. First we have tried to assume that KD value as 10, and when we calculated, the present value comes to as 112.2, which is more than 94. We are supposed to means we have to find out that what is the value of KD equal to 94. When we assume KD as 10%, it is coming not as 94, it is coming as 112.2. That means the value of KD has to be increased to reduce this value. We increase the value of KD to 20%. We can do for 15 also, 16 also, 17 also, but there will be repetition. There will be repetition. Just to avoid those number of calculation, we have taken an extreme point, that is 20%. Now when we take up the value of 20% present value, it is coming to as 72.9. That means now it is less than 94. That means at 10% it is more than 94, at 20% it is less than 94. That means we are sure the value of KD lies between 10 to 20. Somewhere between 10 to 20, or else we can say 10 plus something, but less than 20. Now we take the help of interpolation. By interpolation, statistics, the value of KD is equal to, it is 10 plus something, so we write 10% plus. Now how to calculate? Higher value, we can say higher value minus desired value. Desired is 94. Higher is 112.2 divided by higher value minus lower value, and lower is 72.9, and whole multiplied by difference of the cost. Whole multiplied by difference of cost, and the cost difference is 10 and 20, it makes 10. 20 minus 10, it makes 10, there is a difference. 10% plus higher value is 112.2 minus desired is 94, divided by 112.2 minus 72.9 multiplied by 10. You calculate this thing, 14.66. इसको जोड़कर, है ना? मतलब ये आया 4.63. So after calculating, we can take 10 plus 4.63 is equal to 14.63. We can say is the value of KD exact percentage. This is the way we try to calculate the cost of debts making use of hit and trial method or trial and error method, and making use of interpolation. Always remember that there will be some variation when we do by trial and error method and when we do by shortcut method. Because when you make use of your calculator, there will be difference in rounding off. Right? When we make use of standard table, then also the difference may be with respect to rounding off while calculating the present value. तो प्रेजेंट वैल्यू का राउंड ऑफ आपने कैसे किया है, लोअर में किया है, अपर में किया है, so that may be the difference here. These values are standard. That is why it is always advisable, avoid calculation, avoid calculator, try to make use of standard value. And when you take the standard value, then you round up also standardly. That 0.50 के ऊपर होगा तो 1 जाएगा, नीचे आएगा तो lower value जाएगी. So in this way we are able to calculate the cost of debts with respect to redeemable cost of debts, right? See, just now we have seen how to calculate the cost of debts with the help of trial and error method. The only issue was the interest amount was same, 12.5 rupees. Which was regular for next 7 years. So there can be two ways. That was a long cut method for that. Trial and error में ही एक shortcut और हो सकता है कि आप present value factor की टेबल ना देखकर annuity की value देख लीजिए. That method is always appropriate if your cash flows are irregular. That means they are not uniform. If in the first year you receive 100, second year 200, then 150, 190 or 180, that means every year cash flows are changing, then you are supposed to follow the method that we have discussed just now. But as your cash flow was uniform for 7 years, so you can take the help of annuity. You can take the help of annuity. Right. See, just now we have seen that as our numerator were regular, they were uniform, so we can make use of annuity value. What we have done, present value, interest factor, annuity. Annuity value, annuity table that you have to look, and that will be multiplied by 12.5. The value for 10%, 7 years, because we have taken KD as 10%. It is coming as, the value given as 4.868. And this you will not take for the annuity. Reason being, it is the 100 value itself. So 0.513, so you have to refer two tables. Till regular payment, annuity, wherever irregular start, simple present value table. So for 7 years, it was regular, and for 7th year itself, the maturity was there, it was rupees 100, we became irregular, we have taken present value factor. We calculated, we are getting 112 point something, which was same as we calculated in the tabulation. Then 20%, again we took for 20 years, for 20% and 7 years multiplied by present value interest factor. Remember this thing, again I am saying, annuity without annuity. And we get 72.96, the same thing here. That means we get these two values. In between 94, we apply interpolation and we get the same result. What I mean to say, that you can make use of the tables that will be beneficial for you. We have taken both the case, whether we have taken the present value interest factor as well as the annuity constant. So 14.63 is the value of KD. But as the tax rate is also given in this problem, so this we can say this is before tax cost of debts. Now we have to calculate the after tax cost of debts. What we can do, that before tax cost of debts 1 minus T, and T, as you are aware, that 40% is given. So what we can do, that 14.63 1 minus 0.40, that means 14 multiplied by 0.60. Whatever the value that we get, that will be the cost of debts after tax. So after doing the calculation of this, we will get as 18.78 as the exact value of cost of debts. So in this case we have calculated the cost of debts before tax as well as after tax. I hope now this problem with respect to cost of debts is clear to you. Okay, thank you all of you.